personal lines outlook remains as stable as does the outlook for personal auto, which represents over half the premium in the personal lines space. We changed the homeowners outlook to stable from negative this cycle. Over the past few years, personal lines carriers faced challenging macro trends, including a hardened reinsurance market, escalation in severity and frequency of weather events, unprecedented inflation, rising medical costs, as well as supply chain and judicial disruption due to the pandemic. Collectively, issues led to large rate needs for many carriers, as evidenced by the combined ratio reaching a 10-year high in 2022. However, it has since improved year over year and appears on track for continued improvement in 2025. Comparatively, better results reflect participants aggressively refining underwriting risk portfolios and applying considerable premium increases to the in-force book in a push for rate accuracy. Sizable rate increases over the past few years reflect new loss cost trends. However, the velocity of rate requests overwhelmed some regulatory bodies who required extra time to review requests. That said, much of that latency appears to be worked through. Regulatory bodies have been more accommodative, with rate increases being widely approved, acknowledging the changing conditions. The size of rate increases is diminishing, especially in certain parts of the nation for personal auto coverages where modest rate decreases are surfacing. Rate pressure in personal property is also diminishing, though more widespread, but moderate increases continue. One of the contributing factors is the softening of reinsurance costs, which provides moderate relief to primary carriers. In addition, carriers continue to find ways to leverage technology to identify areas that may require de-risking, get more granular in price segmentation, and apply underwriting changes in quicker and more effective manners. Finally, the rise in interest rates helped boost investment income for carriers who locked in higher rates to either offset or support underwriting results. While we consider this segment stable, we expect carriers to continue to enrich portfolios with greater use of data and technology to keep pace with trends and improve underwriting ability. The reported volatility of the past has made it more apparent for carriers to implement processes and systems that can quickly pivot to changing dynamics. In some ways, this hinges on an efficient technology platform that operationally improves a carrier's ability to exact change in underwriting guidelines and rate structure. In the near term, we expect carriers to remain focused on protecting solid risk-adjusted capitalization positions through refinement of core operations, especially for those who have reported underwriting volatility in past results. With reinsurers relaxing rates, it provides some relief to the bottom line and an opportunity for primary carriers to further insulate balance sheets should they so choose by filling in reinsurance programs or increasing capacity. We also expect carriers to continue to refine their views of aggregate exposure given the continued frequency of weather-related events. While aggregate conditions and results improve, carriers unable to manage the tumultuous past will likely face ratings pressure, while those who have managed well may not. In either case, with a profound number of rate changes, consumers have been more actively shopping, which may spur a more competitive landscape.